Imagine America in 1945. World War II had just ended, and millions of servicemen were returning home, eager to start families and build a new life. But there was a colossal problem: nowhere to live. Cities were overcrowded, housing was scarce and expensive, and construction had practically halted during the war. Veterans and their young families were crammed in tiny apartments or living with relatives, desperate for a place of their own. The American dream of a home seemed like a distant fantasy. This wasn't just a personal struggle, it was a national crisis. The demand was unprecedented. Nearly 16 million Americans had served in uniform, and the baby boom was just beginning. The nation needed millions of new homes, and quickly. Private builders couldn't meet the scale of the challenge alone, nor could ordinary Americans afford the large down payments and short loan terms that were standard before the war. Something drastic had to change in the fundamental economics of housing. The government already had a tool, though largely untested for this scale: the Federal Housing Administration, or FHA. Created during the Great Depression, its original purpose was to stabilize the housing market and provide jobs. The FHA didn't lend money directly. Instead, it insured mortgages, guaranteeing to pay the lender if the homeowner defaulted. This made lenders much more willing to offer longer terms and lower interest rates, reducing their risk significantly. But it was only a start. Then came the real game changer: the Servicemen's Readjustment Act of 1944, better known as the GI Bill. This landmark legislation provided returning veterans with a host of benefits, including educational opportunities, unemployment compensation, and crucially, guaranteed home loans from the Veterans Administration, or VA. For the first time, millions of Americans could buy a home with little to no down payment, and at incredibly low interest rates. The combination of FHA insurance and VA loan guarantees was a financial revolution. It de-risked homeownership for both lenders and buyers. Suddenly, a returning soldier earning a modest salary could envision owning a home that once felt unattainable. It wasn't charity, it was smart economics. The government understood that a stable, home-owning middle class was the bedrock of a prosperous and resilient nation, especially in the looming shadows of the Cold War.
But enabling loans was only half the equation. You still needed houses. Enter innovative builders like William Levitt. He saw the immense potential in this new financial landscape. Levitt didn't build individual homes, he built entire communities. Applying factory-style mass production techniques to construction, he revolutionized home building, making it faster and cheaper than ever before. This wasn't just building, it was industrializing the American dream. Levitt's method involved breaking down the home building process into 27 distinct steps, with specialized teams moving from house to house. Standardized designs, pre-cut lumber, and pre-assembled components slashed costs and construction time. A house that might have taken months to build could now be completed in weeks, sometimes even days. The assembly line had arrived in housing, delivering affordable, uniform homes at an astonishing pace. The first Levittown on Long Island, New York, became the template. Thousands of nearly identical homes, complete with appliances and landscaping, sprung up on former potato fields. These weren't luxury estates, but they were modern, comfortable, and crucially, affordable. For $6,900, a veteran could buy a 3-bedroom house with a white picket fence, needing only $50 down thanks to the VA loan. This mass migration to the suburbs wasn't just a housing trend, it was a powerful engine of economic growth. The construction boom created millions of jobs, from lumberjacks and factory workers to plumbers and electricians. The new homeowners needed furniture, appliances, lawnmowers, and cars. This demand fueled growth in countless industries, from steel and automotive to textiles and retail, driving an unprecedented post-war prosperity. The suburban explosion redefined the American economy. Suddenly, instead of central city living, the car became indispensable. Roads and highways expanded rapidly to connect these new communities to workplaces and shopping centers. Gas stations, drive-in theaters, and eventually sprawling shopping malls became hallmarks of the new landscape. The automotive industry boomed, along with all the ancillary businesses it supported.
Beyond the sheer economics, suburbanization had a profound social impact. It fostered the image of the nuclear family, with a working father, a homemaker mother, and children playing in spacious backyards. These communities offered a perceived escape from the crowded, often gritty realities of city life. They promised safety, good schools, and a sense of belonging, forging a new American identity for the emerging middle class. This wasn't just about providing homes, it was about social engineering, whether intentional or not. The FHA and VA programs, combined with mass production, created a distinct suburban lifestyle. The desire for homeownership became deeply ingrained in the American psyche, a fundamental part of the American dream, symbolizing stability, success, and upward mobility for generations to come. It was a powerful vision, but one with a hidden cost. While millions of white Americans found their path to prosperity in the suburbs, a darker side of this financial revolution emerged: systemic exclusion. The very government agencies that enabled the suburban boom, the FHA and VA, explicitly or implicitly promoted discriminatory practices. Their underwriting manuals often redlined minority neighborhoods, deeming them risky for mortgage insurance, regardless of individual creditworthiness. Redlining was not subtle. It was a formalized policy of drawing literal red lines on maps around areas deemed undesirable, often because of their racial or ethnic composition. This effectively cut off access to FHA and VA loans for residents in these communities. Without government backing, banks were unwilling to lend or only offered predatory loans with exorbitant interest rates. The financial spigot was simply turned off. The consequences were devastating and long-lasting. While white families used low-cost, government-backed mortgages to build equity and generational wealth in rapidly appreciating suburban homes, black families and other minorities were trapped in disinvested urban neighborhoods. Property values stagnated or declined, businesses closed, and schools deteriorated. The American dream became a starkly segregated reality. This financial exclusion wasn't accidental. It was a direct result of federal policy that reinforced and institutionalized racial segregation. It actively shaped the racial composition of neighborhoods across the country, creating disparities in wealth, education, and opportunity that persist to this day. The very system designed to expand opportunity for many simultaneously closed it off for others, locking them out of the greatest wealth-building mechanism of the 20th century. The impact of redlining extends far beyond housing. It affected every aspect of life in these communities. Businesses struggled to get loans, making job creation difficult. Property tax bases dwindled, leading to underfunded public services, including schools. It created a cycle of poverty and disinvestment that was incredibly difficult to break, cementing a racial wealth gap that would endure for generations. Eventually, federal policies explicitly sanctioning redlining were outlawed by the Fair Housing Act of 1968, but the damage was done. The patterns of segregation and economic inequality had been firmly established. The initial push for suburbanization, while seemingly benign and economically beneficial, had inadvertently laid the groundwork for many of America's modern social and economic challenges. Today, we grapple with the legacy of these post-war housing policies. We see it in the sprawling urban-suburban divide, in the challenges of affordable housing, and in the persistent racial wealth gap. The choices made by government and financial institutions in the 1940s and 50s continue to reverberate through our cities and our economy, shaping who gets to live where and who gets to build wealth. The mortgage that forged a nation was a double-edged sword. On one side, it unleashed unprecedented prosperity, creating a vast middle class and fueling decades of economic growth. It democratized homeownership for millions, fulfilling a fundamental promise to returning veterans and expanding the American dream for many white families, literally building the physical and financial landscape of modern America. On the other side, it systematically excluded entire communities, cementing racial segregation and fostering cycles of disinvestment that continue to impact our society today. It created a differential in wealth accumulation that has proven incredibly difficult to overcome, highlighting how well-intentioned economic policies can have profound and often unintended social consequences that perpetuate inequality. So, the story of the post-war housing boom isn't just about suburban idols and economic miracles. It's a complex tapestry woven with threads of opportunity and exclusion, prosperity and systemic disadvantage. It's a powerful reminder that financial policies, no matter how technical, are deeply intertwined with social justice, and their impact can ripple across generations, shaping the very fabric of a nation. The genius of the FHA and VA loan programs was their simplicity, shifting risk from private lenders to the government, thus opening up homeownership. This simple shift, however, created a powerful feedback loop. Affordable homes led to stable families led to stronger communities, and stronger communities, in theory, led to a more prosperous nation. But the execution of this genius was profoundly flawed, creating deep societal divides. It demonstrates how government intervention, even with seemingly benign intentions, can be a potent force for both progress and division. It shows that economic policy is never truly neutral. It always picks winners and losers, often along existing social lines. The suburban dream for many was a reality built on government guarantees, but the cost of that dream for others continues to be paid. This invisible handshake, this quiet agreement between government and finance, literally built the landscape of modern America. It delivered unprecedented wealth and stability to millions, while simultaneously creating profound and lasting social and economic disparities. It proves that the true legacy of any financial policy lies not just in the numbers, but in the lives it fundamentally transforms, for better or for worse.